Hello, and welcome to the channel for economics and finance. Wi-Fi bread. Today we will be looking into index fund investing. An index fund is a portfolio of stocks or bonds designed to mimic the composition and performance of a financial market index. Index funds have lower expenses and fees than actively managed funds because they are not actively managed. Index funds typically invest in all the components that are included in the index. Examples of an index fund is the S&P 500 index. For example, the biggest market cap companies like Apple with over $1 trillion has a higher percentage and makes up about 20% of the index. But which way is the market currently heading, and is it time to invest even during great uncertainty? According to the OECD Economic Outlook report from March 2023, global growth is projected to improve slightly due to declining energy prices. However, the outlook is still uncertain due to ongoing effects of COVID-19, high inflation, and financial sector turmoil. The World Economic Outlook report from April 2023 by the International Monetary Fund, IMF, also predicts a rocky recovery due to similar factors. The baseline forecast is for growth to fall from 3.4% in 2022 to 2.8% in 2023 before settling at 3% in 2024. What are the advantages of index fund investing over traditional investing, and what are its potential drawbacks? Index funds are a type of mutual fund that tracks a specific market index. They are considered passive investments because they simply track the performance of the index they are following. Traditional investing, on the other hand, involves actively managing a portfolio of stocks and bonds in an attempt to outperform the market. The benefits of index investing include low cost, requires little financial knowledge, convenience, and provides diversification. Disadvantages include the lack of downside protection, no choice in index composition, and it cannot beat the market, by definition. Traditional investing can be more expensive due to higher fees and commissions charged by brokers. It also requires more time and effort to research and manage a portfolio. However, it can potentially provide higher returns if done correctly. In the long term, however, index funds have historically always beaten even the best managed hedge funds, who are actively seeking to beat the market with their carefully put together portfolios. However, the S&P 500 index fund beats 90% of all actively managed hedge funds. And they are full of expert financial analysts getting paid to try and beat the market, and 90% of them fail. So what are the chances that you will succeed in beating the market long term? Is extremely unlikely, but not impossible. There is of course people who are against index fund investing because of its nature of not being able to decide what business you give your money to, and there is fear that the S&P 500 has lots of what's called zombie companies. Highly indebted with extreme risk, but because it's in the S&P 500 index, it receives money from investors even if the company is terrible and is going bust. This leads to the term zombie companies, and as index funds becomes more and more popular, people are worried that index fund investing is just becoming a massive bubble waiting to burst. Which does indeed make sense in terms of rating companies' valuations artificially higher without any fundamental reasoning. And this is the downsides of index fund investing, and it will only get worse because it is historically the best way to invest your capital long term. It could be potentially a bubble waiting to burst into the future. Thanks for watching Wi-Fi Bread. Please like and subscribe for more finance videos. Have a good day.